Hello, ladies and gentlemen. Welcome back. Marwest just reported Q1 earnings. As you guys know, I do have a 1,000 share position in them. If we bring up my Google Doc, again, I am more than happy to show you guys my well simple if you ever do want to see. But I prefer this as this just gives a more quick, concise, here's what it is, rather than, oh, you have to click on it and see what the holdings and stuff is. Now, I am down in it. I have 1,000 shares at 60 cents. It is right now, as of recording, 0.57. So we are down about 5%. That seems very off, but either way, we'll look into it. This is the portfolio currently, so I am blocking it right now. Decisive dividend is 13.5. Canadian Net REIT is 21.8, and Marwest is 11.6. It is one of my bigger holdings out there, and that is why we need to check it out. Now, the reason for the portfolio change is I just took some gain. I feel like Allied and everything might drop. I could always be wrong, but I have a feeling they're going to drop a bit more in their next Q2 report if they do not sell the UDC property. The payout ratio is very high. Yes, they're a dividend aristocrat, but I do have my fears around that. So I sold it, moved it all into Canadian Net REIT. I sold a few other of my positions, and this is what we're stuck with. But this is not a portfolio review. That's just a very quick update. But we do want to check out Marwest because it is a large part of my stock portfolio. As you guys can see, it's about 11%. So they announced this a few days ago. I just got alerted to this on Yahoo Finance today, and let's go take a look. So I did quickly dig down and the management. I was more looking for this following management, blah blah blah, risk factors about Marwest overview. This is mostly what I read. It was just the overview. There's not much. The partnership is a limited partnership formed under the laws of the province of Manitoba and governed by the limited partnership agreement dated April 19th of 2021. Breaks it all down. Class A shares, blah blah blah. The Trust Management Machine, the Trust Management Team, has over 100 years of combined experience in multifamily residential real estate. The current portfolio is entirely in Winnipeg, as you guys can see here. And scrolling out. Oh, sorry, that was way too far out. Breaks it down here. They have a... Sorry, I wish they actually told you the total units, but of course they don't. Here's just some images of the properties just right above me. They're okay. Future acquisitions relationship with the Marwest Group affords the trust the potential opportunity to purchase properties developed by the Marwest Group. The independent trustees will be responsible for the negotiation of the purchase price and other terms and conditions relating to the acquisition of any property from the Marwest Group and or any related parties or third parties with an interest in the asset. The trust will continue to seek third-party acquisitions since the completion of the first third-party acquisition in October of 2022 from other developers or owners of multifamily properties in target markets across Western Canada. Breaks it all down here. What is the business strategy and objective? The objective of the trust are to grow unit holder value through capital investment strategies and active asset and property management, to provide unit holders with stable and predictable cash distributions that grow over the long term, and to grow the trust's assets base across a strategic market through... Oh my god, I'm struggling to read today. My god. Intensification and acquisition program. So that's pretty much what it is. It breaks it all down. If you guys feel free to read all this. So the summary and 2023 results in operation. Occupancy rates. The REIT has reported an average occupancy rate of 98.3% for the 3 months ending March. Excuse me. It was 94.78 in the 3 months ending March 31st of 2022. The average occupancy rate for the first 3 months of 2022 was lower than anticipated due to lower renewal rates at the end of Q4 2022, and it basically breaks it all down there. The NAV has increased again. It is $1.47 compared to $1.44 last quarter. It basically just grew. That's just grew due to property outlook, Anticipates the demand for rental housing to continue to grow as evidenced in the 2023 CBRE Canada Real Estate Market Outlook, where housing affordability has eroded to its worst level and the demand for multifamily rentals is expected to continue to outpace supply. Management is focused on growing the portfolio and unit holder value through increasing rental rates where the market allows, future acquisition opportunities that will increase the overall size and improve the performance of the trust, as well as maintaining a manageable debt structure. The current debt of the trust is all at fixed terms with an average remaining mortgage term of over 6 years. Management believes the organic growth in NAV due to paydown of mortgages over time will lower the debt to gross book value ratio, thereby increasing the NAV per unit. Breaks it all down here, but we mostly care about this guy. Number of properties. We have 4 total multifamily units, 516 compared to 363. It is obvious how they did that. Obviously, they just bought a new property, and boom, there you go. Average monthly rent per suite did increase a little bit. It was $1,528 compared to $1,511. The occupancy ratio is 98.30% compared to 94.78%. Rent collection is almost at 100%, and rent collected in 2022 is 97.51. Going down, you can see revenue increased. The NOI margin is 58.94 compared to 56.25. Breaks it all down. Distribution is literally the same thing. It's like a $21 difference. It's nothing huge. Compensation, I am confused why that's negative. I'm going to talk to Strongman and we're both going to go over this, but I honestly have no idea. Fair value gain on gain loss. Oh, there you go. So it's a fair value loss on unit-based compensation. Fair value gain loss on exchangeable units. Obviously, we had a loss of a huge amount. FFO and FFO per unit. AFFO, weighted average units. So AFFO is up. What is that? That's about $41,000, which is good. Weighted average outstanding units decreased barely 170, about 170-ish thousand units, and AFFO per unit did grow. It is now 0.0165 compared to 0.0143. The AFFO payout ratio remains extremely low. It is 22.72% compared to 26.27%. As you guys can tell with me hiding that chuckle, I'm extremely happy to see that. Marwest is one of the lowest paying REITs I have. The yield is extremely small. The dividend is extremely small. And in all honesty, I'm more than happy to take the very low dividend because the moment they can start hiking up that dividend, and from my email with the CEO, it does not plan like they're going to stop once they start, but they're going to take their time, get ready for it, and then they're going to aggressively start to do it. But this low of an AFFO ratio, I'm more than happy because that's like, what even is that? 76.28% is used in everything else, paying down the debt, focusing heavily on buying properties, etc., etc. NAV, trust units, is a decrease of only 10,000. Exchangeable units, 10,841. There was no change. Deferred units did go up, though. Total outstanding units went up by about 4,000-ish. And yeah, debt to gross book value. If you were going to criticize the company, you criticize them on that. That's really scary. Total interest-bearing debt, $101 million. Total assets is $132 million. The book to gross book value ratio is 77%. That is horrifying to look at. Debt coverage ratio is 1.18%. The net operating income for the period, mortgage payments for the period ending this as well, is 1.18. So it's just, if they took all of this and use it purely for that, they would be okay. At least they'd be able to cover it. And weighted average term to maturity on fixed rate debt, 76.28 months or 3.01%. Breaks it down a bit more. And it breaks it down. NOI, financial cost, fair gain, value property, unit-based compensation, warrants, net income, and comprehensive income is 3.2 million compared to 1.8 mil. Real estate taxes for the 3 months ending March 31st, realty taxes of 232,000 were incurred. The increase over the taxes were primarily due to the addition of the Prairie View Point property. Financial costs, you can see it all right here. Interest on mortgage, loan and financing changes, amortization, distribution, and interest income, which this is our interest right here, which sucks. Oh, what can you do? Fair value, you don't care. Investment properties, opening balance. Capital expenditures, valuation, units. Feel free to dig around up there. Exchangeable units. So it has actually decreased a lot based off of the price wise. Okay, never mind. It's price wise. It's not actually. I was just gonna say, wait, that makes no sense. A little bit scary. The REIT uses significant amount of debt financing in its capital structure. Additional indebtedness may not be incurred if overall indebtedness would exceed 75% of the gross book. The current assets is pretty much the same. The current liability has skyrocketed in that time. It went from 60% to 19.35. I know that might scare people. The liquidity ratio has decreased from December due to one mortgage maturing in January of 2024. It is anticipated that this mortgage will be refinanced at or before maturity. Cash flow, change in cash for the period. So as you guys can see, cash used in financing activity was $508,000. The cash provided by operating activities was $516,000. Cash used in investing was $11,000. Changes in cash during the period. So there you go. So they went from a very large negative to a lower negative, which is honestly completely due to just cash provided by operating activity. Breaks it all down here. To be honest, that's pretty much it. Here you go. So this is it. Principal and interest payments on mortgages payable due in the next 12 months. Total $10 million, and $6.2 million of this related to the Element Phase 1 mortgage that matures, and its management's expectation that, there you go, that this mortgage will be renewed at or before the maturity. So they're just going to extend it. Now, they did this last time, and it's kind of scary given the interest rate environment. The last time they did it, they went from about a 2.7 to about a 3% average maturity. So the interest rate's still low, but it is very slowly increasing over time. Board compensation is pretty much the exact same, which is good because the REITs performed awful. So I'm happy they haven't done too much. Honestly, that's pretty much it. So overall, Q1 is as you expect for this small property. It has a large debt, but the AFFO still easily covers the dividend. They still have a lot of cash flow on hand that they can use to pay off. As you guys saw, they were heavy in the negative cash flow range, and now they're just slightly negative. Next quarter, if they continue doing what they're doing, they should be fine. But me and Strongman are going to look over this on Monday, and hopefully I'll have the recording soon-ish, and then I can share it with you guys about what he says. But my overall opinion, Marwest Properties continues to be the lowest and safest dividend payer in the penny stock REIT industry. My main issue is that debt is still massive, and it's great they can just keep renewing mortgages, but sooner or later those mortgage payments and interest are going to really start to add up. So I'm hoping they put a pause on buying property, they focus heavily on paying off the mortgage. But that honestly is my opinion of it. I don't have too much else to say. You all have yourself a good night. Wishing you nothing but green on Friday. Bye.